Okay, we're going to get started in less than 1 minute. As we prepare to get started, I'm going to give a quick introduction to our team who's present today. I'm Adam Lendy. Ramesh Nachapan and Don Spafford, our investor relations team, are on. Bradley Claudianos from acquisitions is on. April, part of the executive admin team, is on with us today as well too. So that is going to be the turnout from Beyonder Holdings, who's with us today. We're going to get started in just a second here, and if either Ramesh or Don would like to jump in with a few words before I jump in, you guys are welcome to do so.
Thank you everyone for taking time and joining this evening and this afternoon. Covering all the time zones. So we're just more happy to have you on here to go over the outdoor hospitality Sun Fund details and also the Q&A right after that. Once again, welcome you all.
Yeah.
All right, perfect.
I'm good to start.
Okay, Don, if you don't have anything, I'll jump right in. Welcome everyone to our monthly webinar for the Outdoor Hospitality Sun Fund. This is brought to you by Beyonder Holdings. Now, if you haven't caught the news in the past 30 days since our last webinar, or even recently, we were operating as Happy Camper Capital with our management company, our sister company being Beyonder Camp. This is a recent internal merger we've made really to streamline things, share resources, help unify our front. We are now operating as Beyonder Holdings, all the same team, all the same great processes. Nothing has really changed in our operation and our commitment to service. It's really just our front-facing, forward-facing brand. So we do have a few new brand changes, but all our old email addresses and websites and everything will still get you to the right place. So again, welcome to the webinar hosted by Beyonder Holdings. Let's dive into it. So our goal today is going to be not only to talk about the fund, but for some of you, this may be your first time exploring investing in outdoor hospitality. So we're going to talk about some of the benefits in this asset class, some of what gets us excited about this, why we're attracted to this, what we see in the industry, and then of course talk a little bit about how we specifically operate, and then more importantly how this fund is structured and why it's such a great vehicle we feel in 2023. So let's talk first about the camping industry. Justin, my business partner, likes to quote, somebody mentioned him, COVID accelerated all trends. It doesn't necessarily mean it accelerated positive. Some things accelerated negative, some things went positive. The camping industry was definitely accelerated positive. It was something that was on a positive trend for a long time already. In 2020, it really just got the shot in the arm it needed to drive this industry to where it is today. The growth continued, and actually 2021 was an even better year. 2022 was a banner year in the industry as well too. And all signs are pointing to us really having a strong 2023 ahead. We're regularly aggregating data. These are the most recent statistics I can give you right now, but we're going to talk some numbers today. There are 93 million plus camping households in the United States. This was actually a number from early 2022. I don't yet have a new figure on this yet, but the number did go up in 2023. There are over 16,000 campgrounds in the United States. And that's a mixture, of course, public and private, but that number actually has not gone up as the number of campers has, which is a really great number for us when we're in the business of owning campgrounds. It means, of course, there's less supply for those campers to choose from, greater chance that we're going to be able to get the occupancies we want, and of course get the rates that we want as well too, which is excellent for investors. This is a $9 billion industry, which is relatively small, but it's a strong enough base to really give us some stability and some foresight into the potential as to where this can go. Let's talk about just new campers. We mentioned there were 93 million total campers in the United States. The thing is, almost a quarter of those all started camping since 2020. That's a pretty staggering statistic. It certainly beat the growth of any year in the past in this industry. 6.2 million new RV owning households. One great data point we always look at when we want to know where our industry is going, that is the camping and hospitality world, is we look at the RV Industry Association. So the actual industry that sells the recreational vehicles that people buy. When more RVs are sold, we have more potential users. When that growth slows down, it could be a leading indicator for us as well too. So that's a great statistic as well too. 6.2 million. those were banner years for the RV industry and the manufacturers in all three of those years. There was a slight decline in 2022, but that's frankly just because they were filling orders from 2021. They were backlogged on those. And then, of course, this year, we're going to be talking a little bit today about some of the economic concerns. And of course, the big concern we had last year was fuel prices. Now, of course, it's the current condition of the economy today. We're going to talk about that. But 64% of surveyed campers said they would actually camp more often in 2023 than they did in 2022. So there's a lot of great data pointing to why somebody would want to invest in the outdoor hospitality and campground space. So let's talk a little bit about the industry itself. And of course, when we got into this, some of the things that we saw, and of course, some of the things that we strove to change. So we are users in this space. That's one of the things that excites us about the campground industry is the potential to, as real estate investors in the past, we always liked having an asset we could go out and put our feet on, we could touch it, we could see it. That's most of us who are in real estate, we like that tangibility of the real estate. Well, we were camping families. Justin Hoggett and I, my partner, when we founded this, we were camping families. In fact, this was founded on a camping / houseboating trip, this whole business idea. But some of the things we looked at were when we were talking about buying campgrounds is actually wanting to create a great model for guest service. And that's something that a lot of the big players in the industry are really lacking on. Some of these are dated franchisors or dated, groups that just have not quite met up to the standards yet. A lot of mom and pops that are really lagging behind. We're looking at the needs, of course, of younger families, and we'll talk a little bit more about why that's important because our biggest user base potential right now is millennials and Gen Z, and attracting them in as campground users today so that we have the potential, of course, to see them through their raising of their kids and, of course, that next generation and on. So we are of course, focused on the fact that a lot of people are having trouble finding, remote workers finding good Wi-Fi in campgrounds, finding good amenities for their kids, finding clean facilities. On our side, buying campgrounds, we look at the challenges of the owners. And I'll tell you this, a lot of these mom and pops, this is still a predominantly mom and pop business. They have trouble accessing capital they need to keep up with modernization and improvement of their campgrounds. So this is something that lets them run behind in their campgrounds. And then of course, investors, is right now, I'm hearing this day in and day out, have trouble finding good investment opportunities. A lot of the traditional assets that they've been investing in over the past few years, like multifamily, self-storage, mobile home, those are all, the opportunities are really drying up. They're becoming harder to be feasible with the interest rates up where they are. So of course, the challenge is finding, good, solvent and cash flowing investment opportunities for investors. So these are three fronts that we're addressing at Beyonder Holdings between all of our operations is how we create a great guest experience. Ensure that obviously young families have what they need. We, like I said before, our avatar, our target client for our management company is young families and young traveling professionals. So these are going to be digital nomads, people who are homeschooling their kids on the road, people who are working remotely, knowing that if we put good Wi-Fi, clean bathrooms, fun amenities in, we're going to attract people of every age group. We're just building a different mousetrap than some of these other groups have. On the owner side, we're looking to help owners who are upside down or underwater in their campgrounds, behind the times, whatever the case is, get out and recoup say some of what they have built, but also provide great opportunities going forward. So we work direct to owners. We do direct to seller acquisitions to find our opportunities. And of course, we're looking for both buying campgrounds and now providing management to them as well too. And then on the investment side, we like to call it the full hookup experience, and if any of you are RV campers, full hookup is, a type of site. That's one that has all the connections you might need for your camper. So we like to say that, of course, we provide our investors the full hookup experience, making sure that you have all the relevant information. We disclose everything that we get access to in our diligence. We disclose our underwriting. We share with you how we did our work, of course, making a commitment to you that we're going to communicate with you regularly to let you know how your asset's performing, when your distributions are coming, let you know the things that are happening on the property and allow you to have, some comfort in, what's happening with your investment vehicles. All right. So why buy an RV destination? I think I've already hit you with some compelling points, but here are a couple more. I paid a little bit of, or gave a little bit of foreshadowing for this before, but 38% of all RV owners, and there are three predominant generations that are owning RVs right now, although Gen Z is coming up and buying generations now too as they become, or buying RVs too as they come of age. But the three predominant generations out there, the baby boomers, the Gen Xers, and the millennials, Millennials control 38% of all RVs on the road, despite being the smallest representative group of those three generations. So that's huge. Just knowing that this is not a trend that's dying out with grandma and grandpa. This is not something that's going away when the baby boomers, stop traveling. So great statistic letting us know that we've got a long future ahead. We talked a little bit about 2020. It really changed a lot of things nationally. So a lot of jobs went remote in 2020. A lot of those jobs are still remote today. We've got a whole bunch of digital nomads out on the road who are out working remotely, camping, traveling, really living their best lives in that regard. We also had inaccessible housing markets in a lot of the major MSAs nationally. So we had a lot of these millennials who were coming of age to buy houses and were really priced to a point where they weren't able to access at the time. So it was a perfect storm for a bunch of RV campers who are on the road. Although they might, take cheaper options along the way, they do regularly stop into RV resorts like those we buy, so they can have good places to do their laundry and, enjoy a week or even a couple weeks at a time. Obviously travel was changed quite a bit in 2020, and that's still, there are changes that we're still seeing with that going forward this year. There's survey data we've already got just showing with airline prices going up, a lot of travelers are planning on taking other forms of travel, one of those being RV travel. So we are expecting that to stay high this year just based on the inaccessibility of other forms of travel in some regards as well too. What we've seen already just in our short time in this is we've been through a recession in 2020, although a brief one, a brief recession end of 2022. And we have, apologize, my slide's advancing on me here. And we have seen resiliency in this asset class going through those periods. We have seen our business be unaffected. Even fuel prices last year, we thought were going to have a bigger impact on our business. Really, they just changed where our campers came from. Our occupancy numbers weren't really affected, and we'll talk a little bit more about that later on as well too. One of the things we love about RV destinations over other asset classes, like say a multifamily property or mobile home, is you have a lot more ability to create extra revenue. You have a lot more torque, as I like to say, for improving your camping revenue as you would, over say rents on a month-to-month rental or a long-term lease. And we also have the ability to add a lot of ancillary revenue streams, so that you wouldn't get on another property. So adding a camping store, adding rental units, adding food service. There are a lot of things we can bring in that will really boost the revenue much easier than you can in a lot of other assets. So these are a few of the reasons that we think it's imperative that everybody give some credence to RV destinations this year and why we believe it's such a strong investment vehicle. So today we're going to be talking about the Outdoor Hospitality Sun Fund. And we'll get into the nuts and bolts of this, but this is an open-ended fund, which means that we're not going to be presenting a specific opportunity to you today, although the fund does currently have a campground in it, which I will share with you. And we are currently fundraising for an expansion on that campground that's in it. In general, this fund is looking to raise $25 million that it's going to deploy over the next year or so on roughly 6 to 8 campgrounds total. So it's imperative to know what we look at for our selection criteria to know what makes the cut for us. We have very specific standards that we look at when we're doing an acquisition. And if our properties don't hit our acquisition criteria, we don't move forward on them. So I'm just going to share some of the basic things we look for today when we're buying an RV campground. The first one being, of course, its main source of income needs to be from camping. We're not looking for a property that is an event center, but also has a few RV sites out back. We see this a lot with equine properties. It might be a big horse property, but they have 6 RV sites on it. That's not our bread and butter. We are a camping first company. We're hyper focused in this space. For our model to work, and I'll talk a little bit more about our remote management model, we really have to have a minimum of about 100 RV sites or 100 rental units. That could be cabins or glamping units. But we do have a very large payroll at our properties, given these are hospitality properties. And we found for our numbers to work and to give the investors the returns we're looking for, typically about 100 sites or rental units is the minimum. We are looking for amenity and feature-rich campgrounds. So we like to be near water or have water on the property. We like to be near big attractions, fun things to do for kids and for families who are coming out. We want people who are inspired to take an extra long weekend, take a week to come out to the properties that we own and control, have fun things for them to do. And of course, a lot of these are extra revenue generators for us too. So obviously, like I mentioned before, the ability to add a store, restaurant, or some other means of creating income, which could come through laundry or rental units, a lot of different ways to do it. We want to be within 100 miles, typically 100, 150 miles max of a major, at least one major metropolitan service area. So meaning major city that's growing, that has multiple industries in it. And I talked a little bit about how fuel prices surprisingly didn't affect us last year. This is the main reason I point to that we didn't see that effect. What we did see when we looked at our reservation data, and we've got great analytics on this from our online reservation systems, we can see where our campers live and where they were camping. So whereas in 2021, when gas prices were lower, we had a lot more interstate travel, people traveling between states to vacation. What we saw last year was that people were still getting their toys out. Even when gas prices were up to $7 a gallon for regular unleaded, people were still getting out with their campers, but they just didn't want to go as far. They wanted to go somewhere that was within a tank of gas out and back. So that's where this 100 to 150 mile max radius for us and our selection criteria really helped, making sure that we had our campgrounds full of users, like I said, just change where they came from. Being near major attractions, like I said, we are looking to be both the destination and the base camp near the destination. So we are looking to attract people in, by being near those. Of course, being off of highways, being easily accessible for people with large campers is always very helpful as well too. But most important for our investors, one of our big things we do, one of our initial analyses we do is a cash flow analysis. So when we underwrite a property, when we first come into contact with a seller, and as I mentioned, we are direct to seller in most cases. We rarely work through brokers, which is one of the things that we're very proud of, is the opportunities that this brings us. But we're looking for a minimum of 12% average cash on cash over 5 years. If we don't see that in our initial analysis, we typically kick it to the side, unless there's some reason to think that the business has been run poorly. There's a major expansion opportunity that could bring it there. But I will say, as a general rule, that's one of the first deciding criteria, whether something moves forward with us or not. So without further ado, let's talk a little bit about the Outdoor Hospitality Sun and Fund. As I launch into it, I'll share my disclaimer up here on the screen. This is also available in the investor portal. So if you would like to see this, you can go to investors.beyondercamp.com. And of course, if you're not already a user, just request access. One of our investor relations team members will reach out to you quickly just to help you get verified and get your access into the portal. You'll be able to read the disclaimer. You'll be able to read actually everything that's in this presentation today. So don't feel like you have to take notes. Certainly keep any questions you have, and you can put them in the chat. We'll address those at the end of the presentation today. But you can go back and review this. Again, the portal is investors.beyondercamp.com. Just put your info in. You'll be able to see all this info and also view the opportunities that we're going to work through today. So the Outdoor Hospitality Sun and Fund, as I mentioned, is it's a real estate investment fund that's open for 1 year, and it's going to be, it's what's known as a blind pool fund. We have a very specific asset. I shared the acquisition criteria, and we're going to be deploying the capital as we raise it and after the fund is closed, until we have deployed the $25 million along with debt to buy the properties. Meaning, of course, we're looking to take loans on the property. We are targeting typically about 70% loan to cost loans for our purchase and our expansions, that are going to be coupled with that investor equity to buy the campgrounds. This is a 506c fund, which means that this is for accredited investors only. This will require third-party investor accreditation verification. We are partnered with North Capital, who, if you would like to invest with us through our portal, will allow you to do the accreditation process with them once you've made your investment request. If you have a letter already that's within 1 year from a prior accreditation verification, we can accept that as well too. So if you have any questions about that, of course, reach out to either Don or Ramesh with any of your questions on that. The fund structure is going to be an ownership structure of 65% to the LP, the limited partner, that would be you, 35% to the GP, that would be us at Beyonder Holdings. We have 3 classes of share that we are offering, and this is something I'm really excited about because to my knowledge, I don't know of another fund that offers this exactly the way that we do. Others do have preferred rate of returns that increase with your investment amount. We have class A, B, and C shares, And the threshold between those is the investment amount. So the minimum of $100,000 investment up to $250,000 is a Class C share at an 8% preferred rate of return. 250 to 500,000 is a Class B share at 9%, and anything over 500,000 is a Class A share at 10%. Now, here's what I think really differentiates us from other funds in this regard. We will allow all shares invested to be to be leveled up. So a great example would be if today you're only able to put in $150,000. However, 3 months from now, you decide to put another $200,000 in. You would then, all of your shares, not just the new shares, but all of your shares would be elevated to a Class B share. And then if another 2 months later, you found another 150,000 to invest, putting it up to 500,000, we would take all of your shares invested and bring them up to Class A shares. So that ability to level up, to ratchet those up, I think is something that really sets this one apart. The other important thing to mention is this will act as a ratchet. So if we do a return of capital event along the way, and we return capital to you, we will not bring your share class down. If you've earned a Class A share, you will remain a Class A share for the life of the fund. So let's talk a little bit about the life of the fund. The fund is structured at 8 years. We don't plan to hold any property within for more than 5 years. That is the plan. The reason the fund is 8 years is obviously the first opening or the first closing happened in November 2022. The second closing, when we will be done with the fundraise, is going to be November 2023. At that point, we are allowing ourselves potentially up to a year to deploy that capital to buy the right properties into the fund. I don't know that it will take that long. We're very good at finding great deals. I nod to our acquisitions team for that. But the idea being that we will at that point be potentially 2 years in when all properties are purchased. So we're giving ourselves a chance, of course, to deploy the capital and the capital improvements in those properties, stabilize them, operate them, get them ready for sale, liquidate the properties, and then have a final wrap up on or before 8 years. So it's not necessarily defined that it has to happen at 8 years. Of course, if we've hit our goals and all properties liquidate sooner, it could liquidate sooner. The great thing about our structure, something I'm proud about in every one of our deals, is that we do allow investors to have a vote in those liquidation sale events. So we do require a 75% vote of investors for any liquidation to occur. So there will be a say from investors, but obviously we'll suggest if we see an opportunity to potentially exit earlier, or if we think there's a reason that it might be advantageous for us to maybe hold on a little longer. So that's just something to keep in mind as we go. We do quarterly distributions that begin on the first full fiscal quarter of any property ownership within the fund. So what that means is we purchased the first property into this fund in December of 2022. I'll share more about that in a moment. We will be analyzing that for the first potential distribution at the end of Q1, which will be of this year. So at the end of March for its first potential distribution. So if we were to purchase the second property before the end of this quarter, the first time we would analyze it for a potential distribution would be at the end of Q2. We have an array of fees that a couple of which slide with the size of the purchase and the requirements of it. We do like to be as fair as we can with those fees. The acquisition fees do slide from 2 to 4% based on the size of the property. We have purchased some smaller properties in the past, not smaller in size, but smaller in deal. So one in particular was a value add opportunity that was only $1 million purchase. So obviously that ended up on the higher end of the acquisition fee scale, but as the price goes up, that acquisition fee comes down. We like to keep that reasonable. The ongoing fees that we charge on the asset management side, we charge a 2.5% asset management fee. That's 2.5% of the effective gross income, meaning the gross income minus the cost of goods sold. And then the property management fee that goes to Beyonder Camp Management is 7.5% of the effective gross income as well too. If we do secure debt and Justin and I, or I should say anybody guarantees that debt, we make a loan and financing fee or a guarantee fee available for that person. So there's in this space, there's traditionally not a lot of non-recourse debt to this point. I think as this becomes a more established asset, we'll see that. So for now, Justin and I in particular are guaranteeing most of the debt on these properties. But we will bring in other partners as guarantors as needed if we exceed our own means of guaranteeing these properties. All right, so let's talk a little bit about our strategy and what we do uniquely here at Beyonder Holdings when we buy these properties, and of course, what we're looking to achieve, and also within the fund. So first thing first, we are looking in multiple markets. As opposed to holding just one property, and I apologize, I've got a little bit of a scratchy throat today, so bear with me 1 second. If we buy one property in one market and that market is impacted by, say, a natural disaster, or if there's any kind of a migration change, that could affect all the income for that property. Whereas when we buy in multiple markets in this fund, we're actually creating some diversification just by being in multiple markets. So if, say, a hurricane hit a property in Florida that we bought into the fund, we could still have the property in Louisiana. We could still have properties in other states that we're buying that are supporting the investor returns, supporting the business. This is also going to create some cash flow stabilization as well too, because this is a seasonal asset class. And even in the southern states, even in the Sun Belt where it's a little warmer year round, there's still a certain amount of seasonality where we get a lot of our revenue in in 2 quarters, and the other 2 quarters are typically lighter. This is a normal thing in this hospitality space. So this will actually even out the cash flow availability throughout the year by having potentially northern states that make all their cash flow in quarters 2 and 3, southern states that make theirs in quarter 4, quarter 1. So it really helps blend things out. We are targeting for the fund what we refer to as blue chip properties. These are properties that already have a history of cash flowing, or they're in a market that has a history of cash flowing. We're not looking to put anything experimental in. We typically haven't bought anything, or traditionally have not bought anything experimental per se, but these are going to be properties that we have strong expectations are going to perform very well. Again, this allows you, the investor, to make one investment into the fund, but leverage it into those multiple properties, adding that diversification. A couple great value adds we have is we control everything end to end, from management, construction management, all of the projects we're seeing, and of course the property management itself. We're handling this all in-house. I like to say that it's an end-to-end service, giving us total control to help maintain budgets, to help maintain communication, and of course project deadlines as we go along. Finding good contractors is tough. We've got a dedicated gentleman on our payroll who specifically seeks out the right and manages all these projects to help keep them on schedule. And to date, he's already exceeded a lot of our timelines and accelerated some of them in other cases as well too. So our general business strategy when we go into a property is, first off, the very first thing we do is we work on revenue optimization. So what I mean by that is getting our camping revenue up. And some of the simplest ways we can do this is with technology. A lot of campgrounds, I mentioned this is still a predominantly mom and pop business. A lot of campgrounds don't have campground management software. They don't have online reservation systems. Some of them, some of the most extreme examples, still use a cork board and 3x5 cards that they pin on the wall when a reservation comes in. They have one rate for every night of the week. They miss the opportunity to catch millennials who don't want to make a phone call to their campground, and they would rather just book online and we'll go to the next campground that does. So when one of our day one plans is actually, we plan this before the closing even happens. We have a gentleman on our staff who gets our software in place so that on day one, when we launch with a website, online reservations, campground management system. We have systems in that not only just allow people to book online, because that everybody's starting to do that now, but we even have systems that will adjust the pricing according to the occupancy, according to the days of the week, the holidays, really making sure that we're maximizing the daily rates that we're getting in our sites. And this is something that we don't just do once. This is not a set it and forget it. As we complete our amenities, as we complete our expansions, as we add new features, we're constantly analyzing those rates. We're constantly looking at the holidays, the major events in town, and adjusting our rates accordingly to make sure that we're getting the top rates that we can get for our market. This is something the hotel industry has been doing for years. The RV industry, frankly, has just not been there. It could be availability to technology. It just could be complacency, but it's something we're certainly, I should say, grabbing by the horns to make sure that we're not leaving any opportunities on the table. One thing we always look for in our campgrounds is the ability to expand. So anytime we see unused acreage, or like in the example I'm going to share with you in a moment here, acreage next to the property, and there's a demand for more sites, we will look at an expansion plan and adding those extra sites, adding the extra accommodations or amenities, whatever that market demands. As part of our analysis, we're going to look at the occupancy rates of the campground we're buying, the other campgrounds in the area, and determine if it would make sense to add more cabins, add more RV sites, add glamping units potentially. Maybe if it's a marina property, adding another dock to the marina. Whatever the case is, we're going to go in with an expansion plan if that's a fit. That's a direct revenue generator, bringing more camping revenue to the property. Some of the other things that we can do that are a little more indirect in revenue generation is just going to be improving the amenities. You might not necessarily always be able to put a direct line revenue in for having cleaner, more modernized bathrooms, or for having extra fun things for the kids to do. However, you're surely going to see it in your bookings as people make good reviews on the property, which is going to increase the bookings, of course, getting people to make longer stays. And all of this is going to lead to commanding the top daily rates in the area. So some of the amenities we add will actually drive direct revenue. A great example is rental golf carts. We can't, in most of our properties, buy enough golf carts to satisfy the demand we get. They're a great driver of revenue. You can see that as a line item on the P&L. Where some things like, for example, putting a new swimming pool in, or like I mentioned, cleaning up or remodeling the bathhouse, that could be something that will have a long-term improvement in your revenue. And then, of course, monitoring and optimizing expenses. That's something that we really take a lot of pride in our systems for. A lot of this ties back to our management system. So Beyond Our Camp, our management company who oversees the properties, has a remote management model in place wherein we have a single point of contact manager who is on site in the properties, who is managing the day-to-day, and we incentivize them as a business owner. This is good news for our investors. We don't have an employee who's just manning the desk and punching in, punching out each day. We have a member of the team who takes ownership in the property and who is bonused in the same way a business owner would be. If they have a top line revenue budget, if they hit their budget, they get a bonus. But if they exceed their budget, we give them an uncapped bonus based upon the amount of revenue they generate for the property. So we are really incentivizing them to drive as much revenue as we can. On the contrary, on the other side of that, we have the expense ratio. So if they hit their budget for their expenses, they get a certain bonus. But if they drive their expenses down even lower than that, if they really rein in, their spending, then we give them an increasingly large bonus on that too. In addition to, of course, to bonusing them based upon their guest satisfaction scores and their employee review scores. So that in itself helps us drive expenses. The other, of course, is going to be just economies of scale. The fact that we have multiple campgrounds operated by the same group allows us to group our expenses together. There's some things that we get to share costs on that a single standalone campground owned by a mom and pop wouldn't have access to. Some of the group buying power we get through some of our vendors. And then, of course, after I shouldn't even say after, because really this is something we start doing day one on our properties now, is we start working on a depreciation plan. So we have a great vendor we're working with who's doing cost segregation studies for us to work on an accelerated depreciation plan. We actually just got our first ones back at the end of last year. And I should say that our expectations were greatly exceeded by the response on what accelerated depreciation was available for 2022. So let's talk about the very first property that's in the fund. So anybody who invests in the fund today will take part ownership in Beyond a Resort Cajun Moon. This property was closed December 14th of last year. This is in Sulphur, Louisiana, which is just outside of Lake Charles. This is a 188 site campground, although I've got a typo in here. It says 128 site. I apologize for that. 188 site campground with 32 room motel. This was $7.2 million purchase price. We purchased this one at a 9% cap. So just to give you an idea of this asset class, and this is again a nod to our acquisitions process. At the time we got this under contract, campgrounds were trading for roughly 8% cap. So nine cap on this here is about a 12% difference in price over what this could have potentially traded for at fair market value. Big opportunities for us on this property are somewhat, of course, to improve the amenities and, of course, just add some more revenue streams. We've got great opportunities to add a bar, for example. There's an adult pool that's separate from the family pool, to add a bar in that area, to add liquor sales into the store, to beef up the store revenue offerings. This campground and motel surprisingly never had online reservations. It now has online reservations. That was one of those things we implemented day one. But the current thing we're working on, and this is going to be the opportunity that's tied with this today, is an expansion. So there's 9 acres next door to this property that we are currently under contract to buy, to expand the property onto, to add an additional 70 RV sites. So I'll share that with you today. This is what we're currently raising into the fund to cover, in addition to, of course, other opportunities we have coming our way. So you can see the treed area on your screen that looks like the state of Oklahoma. That is 9 acres that butts up to the south side of Beyond a Resort Cajun Moon that we are currently buying, currently under contract on. The current zoning on it does not support the building of RV sites. However, we are in the process of having it rezoned. We have a contract on it that's contingent upon getting the proper zoning. So all signs are pointing to we shouldn't have any trouble getting that. It will go to hearing in a few weeks here to determine if we can get the zoning we need. And then once we get that zoning, we will be closing on it shortly thereafter within a couple weeks and beginning the engineering process to add 70 more sites to the campground, which are in demand and there would be a need for. You can see actually on the front of this, there is an additional opportunity, which is there's a house. We did not need the house. We actually really didn't have it in our plan to buy the house, but it comes with the land. So we actually have an additional income opportunity to rent that house out or even to use it as a caretaker house for our manager. So this is something we're currently working on right now. The purchase price on that land is $860,000. The intent right now will be to purchase that land with cash, just because the land loans right now are not favorable in the terms. But once we get done with our expansion on the property, we'll be looking to refinance this in with the campground itself. So the entire additional 70 sites will be part of the property and part of the fund. So that is our current opportunity. Of course, we have many other opportunities we're analyzing. Bradley Claudianos, who I've introduced at the beginning, he is working in acquisitions. He's sending in offers regularly. I believe he sent just 3 in the past week on other opportunities that meet our general criteria to see if we can come to terms with other owners. So we will have more opportunities in the very short term. This is what we're currently focused on right now. So don't look at this as just investing in this specific opportunity. Look at this as investing in opportunities like this and those which meet the investment criteria on the last slide. So I mentioned, of course, accelerated depreciation. I wanted to talk specifically about Beyond a Resort Cajun Moon because this is what completely blew us away. We had a cost segregation study done, and the cost segregation study revealed the items that could be depreciated on a 39-year schedule, a 15-year schedule, and a 7-year schedule. And of course, through accelerated depreciation in 2022, we are able to take all of the 7-year and 15-year all in the first year of purchase. In addition to that, we're able to take, of course, our first year of the 39-year depreciation, meaning investors in the fund for 2022 taxes are getting $4,342,000 of depreciation. That is more than 50% of the purchase price back in depreciation for bonus depreciation for year 1. That's a tremendous offset for real estate income or other self-employed income that, or any other qualified income that our investors made. Going forward, of course, each year we're gonna have an additional $75,000 depreciation from this property. Each property we purchase will go through a cost segregation study into this fund. So there will be more opportunities in 2023 for more accelerated depreciation at the end of this year. Once we have those cost seg studies done, I will say on every one of the properties thus far, they've all come back at more than 50% of what we've purchased them at. So really great opportunities for some tax advantages here, coming up in the next year. So we talked a little bit about, talked about Beyonder being the management company. As I mentioned, I just want to hit some high level points. When we started this company, we really wanted to make sure that we were controlling everything in the process. We had our own knowledge and experience of how other management groups can work with a property that's not theirs and how much care they put into it. We had concerns over the ability of a management group to be able to hold them accountable to what we were ensuring our investors or promising our investors we would provide. So we just made a decision at the time to start our own management company. And while that was a large undertaking, a very daunting undertaking, I believe that we've actually built a great model at this point, which we're scaling into providing third-party management now for other campgrounds. So we've got a model where when we buy a new campground, we are able to get on site. We have a full-time couple, husband and wife, who are our onboarding team. They show up on the campground. 30 days before closing, they begin, I'm sorry, 2 weeks before closing. They stay till 30 days after it closes, but they show up on site 2 weeks before closing to begin implementing our systems, begin getting our reservation system ready, begin getting the staff's interviews done, getting uniforms and merchandise ordered, making it so that we can have a really big, great day one ribbon cutting, opening celebration as a Beyonder property within our family of properties. We're hyper focused, like I mentioned, on those young families, making sure that we're providing the amenities they want, knowing that we're going to bring everybody else in. So getting the amenities in place, getting it cleaned up, setting our standards, putting our human resource standards in place too to help protect us against liability concerns or anything else. So it's, I think, one of the biggest advantages we offer over some other groups is that we don't outsource that management. We are focused on the investors, of course, making sure that we're running solvent businesses that are also going to maintain their asset value going into the 5 years and beyond, of course, as we look to maximize those liquidation prices. So to recap everything in the fund, our main goal with the fund is we're looking to buy value add campgrounds and marinas and resorts, that we can expand and really improve the revenues on. Our goal is to create consistent cash flow through quarterly distributions. Some of that's through just our diversification strategy, but of course the diversification also comes to provide a little bit of risk mitigation as well too, should we have any losses or events at any of the properties. And I will mention on that front, if we do have a loss, one thing we take very seriously is our insurance. Insurance is our second largest line item on our expenses next to payroll. We pay for insurance that covers loss of business income. So for example, if we were shut down from a hurricane in Louisiana, we have insurance that would cover up to our preferred return to make sure that we are still providing our investors with what they expect from us. Of course, we're looking to maximize our accelerated depreciation. And of course, the last thing, this goes back to what I mentioned at the beginning. When Justin and I founded this, we were camping families. We want to have assets we could go play with. It's a benefit to our investors as well too. These are assets that you guys get to go out and enjoy. Take your families out to visit. Go check on your asset. Go see it. Go have fun with it. Before we open it up for questions, I want to talk a little bit about our team. Actually, I'll talk a little bit about our exit strategy in the team. So I mentioned this before, of course, and I'm just going to hit on the points of this again. Each property we put in, we're looking to hold for 5 years. So a great example would be Beyonder Resort Cajun Moon. It was purchased in December 22. The planned liquidation is going to be sometime after Q4 2027. Is provided the market is in the right condition and we feel it's the best time to sell and all investors agree with us, that would be the planned time. The overall timeline for the fund is 8 years. As I mentioned, of course, too, the way our agreements are written, any dissolution is going to require 75% vote of investors. So this is not just the operators having total control over that and investors having no say in it. If we do achieve our goals sooner, and if everyone is in agreement that it's the right time, we can do a sale or refinance ahead of time. A great opportunity, or a great example of a refinance event is we had a property we closed last year on seller finance. This was separate from this fund that we are currently working on refinancing, and it's going to create a great cash out event for our investors. So as those opportunities come up, in fact, Cajun Moon may be a great one once we get done with the development. There is potential for cash out refinances along the way as well too. We do have a potential seller or a potential buyer in mind for the properties, which would be the managers. That would be us. So at the time of liquidation, of course, it is to a vote of the investors. However, we would like the opportunity to make an offer at that time. And if it is in the best interest of everyone involved in the right alignment, the great thing this gives investors is a surety that it's going to sell. Whereas you might not always know if the managers or one of the investment partners is not intending to buy the property, whether a sale can be achieved, whether the property is going to sit on the market or, have other failures to sell. So that is something we are looking to do. And if we do, if we purchase and if investors are in agreement with us doing so, we would obtain a third-party appraisal to help support any offers to make sure that everybody feels that we're on the same page. And everybody's goals are being met. So that is going to be about it for the exit strategy. Just to introduce everybody on our team, you've met me today, Adam Lendy, my partner, Justin Hoggett. We're the founders of the company. Don Spafford, who's on with us today, of course, is a partner in the company. Our CFO, Rick Liebman, is the guy who's checking our numbers and of course keeping our budgets in line. Members of our team, Bradley Claudianos is on with us today. He's our acquisitions lead. Matt Whittemore, he's one of our acquisition specialists as well too. Ramesh Nachapan, who's on with us today, is investor relations. I've talked a little bit about Chad Swenson, our director of construction and projects. Chad is saving us a ton of money on our projects right now, actually coming in well under our budgets on a lot of our capital improvements on our existing properties. And like I mentioned, keeping our timelines really in check. And April Hester, our executive assistant, who's on with us today as well too. That is everybody from our team. I'm going to open it up to any questions we have. So let's start with questions in the chat. And then as we get closer to the end, if we need to, we can of course open it up to come off and mute. So Don or Ramesh, do you guys see any questions? Do you mind reading those off?
Yeah, there's one question here from Jeff, just asking about the debt terms. So what are the terms that we are seeing in our debt, and will these be fixed rate debt?
Great question, Jeff. So our debt, debt has changed a lot in the last year. I should say we certainly saw a high rise in the interest rates last year. They have seemed to stabilize a little bit. There's every now and again week to week volatility, but we just got a term sheet on a property today that was for 7.5% interest on a 25-year amortization, fixed for a 5-year term. So we do like fixed rate debt. We would prefer not to have anything that's floating, unless there was a strategic reason we saw that it could be good to do so. But typically right now we're seeing about 6.7 to that 7.5. 7.5 was a little higher today. We had, when we closed Cajun Moon, that was 6.75 in December on that one there. But 25-year amortization is pretty typical, and about a 5 to 7 year term is what we target. Not typically in favor of anything less than that. Typically about 70% LTC is what we're getting on these, so loan to cost for the purchase and any improvements we're doing. All right, any other questions? Great, if we don't have any other questions in the chat, if anybody has any questions, would like to unmute, we would be open for answering any questions.
Go ahead, Praveen.
Praveen.
Yeah, Adam, you mentioned about, the total RVs and the new RVs in last few years. And you also mentioned that you already have data of our campers from where they're coming. So that is like those initial numbers were from all over the country, but are we doing any targeted marketing based on, the new RV owner for the area from where we get the customer from?
That's a good question as far as how we do our marketing. So we have engaged in some of the traditional marketing in the RV industry. A great example would be Good Sam. Good Sam is a big RV industry advertiser in the past. They are becoming dated. I believe they're losing campground subscribers. They were the source once upon a time. Mom and pops would go on the road with a big phone book of campgrounds, the Good Sam book. And although we're still marketing with them, they're only one arrow in our quiver. We're heavily focused on digital marketing. So doing proper SEO, doing proper targeted advertising into the markets that we want to be in and where we know our users are coming from or are likely to come from. So hitting around certain metro service areas, social media is a really big avenue for us, making sure that we're being seen online, that our campgrounds and events are being seen. Our managers are actually right now being trained in a new social media process from a contractor we brought in to keep their campgrounds current and relevant through social media channels. And just making sure that those are getting out. We're actually additionally running a campaign right now to bring RV influencers in. So what I mean by that specifically, there are a lot of full-time RVers who are YouTube influencers and Instagram influencers who have a very large following. So we're actually working to prospect them right now to bring them into our campgrounds to give them a discount to come in and help publicize our campgrounds a little more.
And probably I would like to add, when we analyze the property, Praveen, I think when we do the due diligence, we also do the market analysis and see, how far based on the financials that the sellers provide us and how is it really meeting the criteria. for example, like Cajun Moon, Brad and the whole team, like Jill and everybody else were there even before we bought the property when we did the due diligence, making sure, there is a market potential for the growth based on our projections. So, and also we go out and do all the marketing like Adam said as
No. Yeah, I think thank you, Adam and Ramesh. I think I got good insight. But my targeted question is like, for example, we have a campground near Indianapolis, right? And we have like 70-80% of our customer come from that major metropolitan area. So are we tracking like, okay, in this year, let's say 5,000 more RV owners are added in that whole vicinity? Are we doing targeted marketing or we are just doing general digital marketing?
We're doing marketing we do a targeted marketing in the degree that we for example, if we ran a social or online media campaign, we're going to target people who are interested in RV camping or RVs based upon their search criteria, their interests. As far as tracking down people who are the new RV owners, that is not something we have pursued. It is something we have had proposed to us before, but it's not something we've pursued to do DMV inquiries to actually get that data. I can't say if there would be a good response to that, or if it would be something that would be feasible for us to deploy. But certainly if it comes up through any of our channels that we operate with as something we could pursue, I would consider it.
Thank you.
Of course. All right. Any other questions? Please feel free to come off mute. We got a few more minutes. Okay. Well, if anybody else is thinking of any questions, please feel free to jump in if you have one. What I'd like to invite you to do at this point, of course, is I did throw a lot of information at you today, and I don't expect you to retain everything or have taken notes on everything, but I do want to let you know it is all available in our updated investor portal, which can be found at investors.beyondercamp.com. If you have our former link to our portal, which was investors.happycampercapital.com, don't worry, that will still work. The same link will take you to the website. You'll just see new branding on the website. It's otherwise the same portal. But if you don't already have access, you can easily sign up. One of our investor relations team members, Donna Ramesh, will get the invite request, and they will give you a quick call just to verify a few things before they let you in. But you'll be able to get in right away, and you'll be able to start reviewing the PPM documents, the subscription agreements. They're all available for you in the funds portal. In addition to this presentation, the recording of today's webinar will be out tomorrow. However, we do have recordings from prior webinars in there, so you'd be able to get some of the same information, maybe even some different information from today. And of course, if you have any other questions that come up after this webinar today, don't hesitate to reach out to us. We'd be happy to answer those questions. We expect that at least one or two are going to come up. But as I did advise, we are working toward that land acquisition on the land next to Cajun Moon right now that we're going to be developing. That is a priority in the fundraising process. So if this is something exciting for you, you'll be able to actually see the projections on Cajun Moon in the portal, understand what we're looking at this property, understand why we're as excited about this one, and get in on it so we can make sure that that acquisition happens, that we get your seat at the table in this opportunity and the rest of those coming this year. So again, the portal's at investors.beyondercamp.com. And of course, our contact information is up here in case you need to reach out to or would like to reach out to us. If we have any last questions, I'll leave the floor open for a minute. And if not, we'll wrap things.
Adam, I just want to highlight a few things before we wrap up this, right?
Yes, sir.
Well, yeah, one is we did properties individually before, and based on the analysis, we as a team that we brainstormed like few months, like 2 to 3 months, and came up with this fund process to make sure the risk management is carefully taken care of, like the diversification, seasonality, and also the consistent cash flow. Considering all those factors, we kind of designed this fund in such a way that it's pretty much taking a lot of questions or concerns from the investors' mind, and also putting that comfortable factor in place as far as the consistency cash flow happens, even during these tough economic times. And we have a process and resources and people in place to monitor those and kind of deliver that. And I just want to kind of highlight that. And I also want to highlight two other things, but this is, I know for some people feel this is a new product space in real estate, outdoor hospitality, and it has gained so much momentum, as Adam said, in the last couple of years due to COVID. And it's only gaining momentum. We do a lot of data analysis, and I personally do a lot of data analysis along those lines. And when I was talking to my friends in, like in 2014 about apartments, people were pretty hesitant and nobody started doing anything. And, people, all of, like I always, Warren Buffett says, when everybody's going into the crowd and we have to go opposite kind of things, like 2018, 2019, 2020, everything peaked and so much competition. The prices went through the roof, the cap rates went down. And both in apartment, self-storage and everything. And that is where we kind of as a team went down. And Justin and Adam are pretty much into camping and RV and those space, and they know all the details. So we just came together and working as a team and finding out the growth potential for the next 10 years. I know 5 years from now, everybody might be talking about this real estate space, but we want to be ahead of the curve in enjoying the benefits as early birds coming into the space, and also reaping the benefits and probably looking at how to creatively do things down the road and achieving those growth potential for the next 10 years. And I just want to put it out there for people. You are probably definitely in a greater product, even though it's a new one. You are probably ahead of the curve. People might not know, and that is always a fear factor for us. If you go and talk to anybody else, I have invested in outdoor hospitality. What do you mean? Nobody knows, right? It's like if you invest in apartments, everybody knows. But the numbers, when you're doing business, the numbers speaks for itself. And you just have to be very careful in what you're investing in. And, this is the right time. And especially in 2023, whatever the investments, like the good or great investments that you're going to be making in 2023 and in early 2024 is going to see a lot more benefits 5 years from now. And I would appreciate all of you joining and taking this opportunity and happy investing end of the day.
And I'll add one thing real quick before we check for any last questions and close up for the day, which is that our share price today is $1 per share. We will be completing our first full quarter of property ownership in Cajun Moon at the end of Q1, at the end of March. Based upon its performance, we are going to be reevaluating the share price. So it is possible that if we perform as expected, that our share price could go up. So there is good incentive to not delay getting in if this seems like the right opportunity for you today. Because each share could cost a little bit more in coming quarters. It will be analyzed on a quarterly basis as we move forward. So if one last thing I'll add to, of course, if you saw this today and you think there's someone else in your life, a friend, family, coworker, who might be interested in this opportunity or who this could be a great fit for, feel free to share this with them. So I'm going to send the webinar recording out tomorrow. You have the permission to forward that to them so they can watch it. You can also forward them our website if you think this would be a great fit for someone as well too. But I do encourage you, if this is the right fit for you, sign up today, get in conversation with Donna or Ramesh with any questions you have, and let's get the ball moving forward. So I'll check one last time if we have any other questions, and if not, we'll close things up. Does anyone else have another question? Okay, great. I appreciate everyone taking time out of their evening to come meet with us today. Really grateful for your investment with us. Please let us know if you have any additional questions or if there's any way we can support you. We really look forward to going into business with you and to making this a great fund. Thank you so much for your time.
Thank you, everyone. Yeah.